The year of the tariff just got louder. Hello, and thanks for checking out this week's Fastest 4 Minutes in Finance. I'm Alec Darrell. Markets were rattled again this week after President Trump threatened what he called an obnoxious use of tariffs, following a Supreme Court decision that limited parts of his previous trade actions. Investors don't like uncertainty, and right now trade policy is delivering plenty of it. At the time of this recording, stocks pulled back sharply as traders tried to digest what this could mean for global trade, corporate profits, and the broader economy. The concern isn't just about tariffs themselves, it's about escalation. So what's actually happening? After the Supreme Court ruling cast doubt on certain tariff authorities, the president signaled he could respond with even more aggressive trade measures. That raises the possibility of expanded tariffs on key imports, which could increase costs for the US. Remember how tariffs work. They're essentially taxes on imported goods. When tariffs go up, companies often face higher input costs. Sometimes they absorb those costs, often they pass them along to consumers. That can put pressure on profit margins and potentially fuel inflation. Markets react quickly to that kind of risk. We've already seen how sensitive investors are to trade headlines. Earlier tariff announcements this year triggered significant volatility. Now, the prospect of broader or more aggressive tariffs adds another layer of uncertainty, especially as businesses are already navigating slower economic data and questions about interest rates. But here's the key. Uncertainty does not automatically equal recession. Trade policy can shift quickly, negotiations can happen behind the scenes, tariffs can be implemented, modified, delayed, or removed. The market tends to price in worst-case scenarios first and then adjust as reality becomes cleaner. For long-term investors, this is where perspective matters. We've said it before on this segment, headlines can change daily. Your financial plan shouldn't. If you're 5, 10, or 20 years away from retirement, short-term policy swings should not dictate long-term strategy. Volatility is a part of the process. In fact, markets have faced trade wars, rate hikes, pandemics, government shutdowns, and geopolitical conflict, and over time, disciplined investors have been rewarded. If you're close to retirement or already retired, this is a reminder of why an all-weather, diversified strategy matters. You don't build a retirement income plan assuming smooth markets every year. You build it assuming there will be disruptions. Could tariffs slow growth? Possibly. Could they reignite inflation pressures? Maybe. Could negotiations ultimately reduce trade barriers? Also possible. But the point is, reacting emotionally to policy threats rarely leads to better outcomes. Instead, focus on what you can control: your allocation, your risk level, your income plan, your written strategy. Markets may buckle in the short term when rhetoric escalates, but history shows that disciplined investors who stick to a sound plan are better positioned than those who chase headlines. That's the Fastest 4 Minutes in Finance. Thanks for watching.
Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.